where are we looking for potential support? I mean, is it going to fall hard? I think that if it breaks 39, 32, which is simply based upon this bottom that came in October, then when you look at levels of potential technical support, can you call this a level of support? Not exceedingly strong, but the key, the most important one is going to be this, but that's a huge distance. So the key is this: what we're looking at right now, based on this bottom right here, puts a floor. If in fact we're going to close and see any kind of follow through selling, I'm going to base my revised support at around 3,900 on the low end. The bottom line is when events change and market sentiment changes, then traders react accordingly.
The financial landscape is witnessing an intricate shift as market dynamics challenge long-standing support thresholds, forcing investors to reevaluate their asset allocations. As major indices and commodities trade beneath key technical levels heading into the weekend, previous psychological benchmarks are failing to hold under intense selling pressure. Gary Wagner, a prominent technical analyst and seasoned market commentator, argues that if the market breaks the critical $3,932 baseline, the revised support floor will likely drop to around $3,900 on the low end. He points out that while gold lacks an interest-bearing nature, its traditional role as a speculative asset is being challenged by guaranteed fixed returns. Traders are rapidly shifting their focus away from geopolitical wildcards, such as military uncertainties in Iran, to prioritize macroeconomic indicators instead. With core inflation pressures persisting, the overall market sentiment is increasingly defined by how aggressive the monetary authorities will be in the coming months. Now, we present the clips from Gary Wagner's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
What is most, I won't say alarming, but telling of what we're looking at here is on a candlestick chart, when the low is equal to, or there's very little bottom wick, you can see here it went to these lows, 39, 54, 55, but recovered. The real body stayed solidly above 4,000 here and here. We tested 4,008. The next day it came up. And then, of course, what we're looking at yesterday was a small incremental continuation of that move, but that was not sustainable. Simply put, this low here, when you compare it to the former low, which comes in above 4,000, shows you that we've clearly, at least on an intraday basis and a much higher probability that 4,000 might not hold. If that's the case, because that's what's important, where are we looking for potential support? I mean, is it going to fall hard? I think that if it breaks 39, 32, which is simply based upon this bottom that came in October, then when you look at levels of potential technical support, can you call this a level of support? Not exceedingly strong, but the key, the most important one is going to be this, but that's a huge distance. So the key is this: what we're looking at right now, based on this bottom right here, puts a floor. If in fact we're going to close and see any kind of follow through selling, I'm going to base my revised support at around 3,900 on the low end. The bottom line is when events change and market sentiment changes, then traders react accordingly. Yeah. And what they're reacting to is the 50 or 60 or 70% probability that we will see a rate hike. It's really likely that we will see it before we see a rate cut. The question is, if that's the case, when would they act? Would they act at the next FOMC meeting? Would they act September, December, kind of that thing? And that's what traders and market participants are focused upon, because the probability of a rate hike has gone up. This particular study is not showing this as an aggressive level of moving lower, but as you can see, we've moved past this line. They put it at 4,200. With a potential bottom if it does go much lower than my sentiment. But nonetheless, we could see anything happen if the Fed policy changes, because that's what's going to be most important. They're focused upon the geopolitical uncertainty in Iran, but the focus has really shifted in which they're putting their priority on inflation and interest rates. Because if inflation keeps ticking up, it's the only tool the Fed has is to make rate hikes. I think that when you compare gold and silver pricing, there is an underlying theme of what we expect to happen, and I believe we're seeing that also. In times of strong bullish market sentiment, silver will typically outperform gold in terms of percentage gains. On the other side, when there is bearish market sentiment for the precious metals, silver's decline will be a greater percentage than what we see in gold. And so that could be what you're talking about. But when you put these silver and gold side by side, you can see that they both hit an apex. And I do have a chart for that, but I can just illustrate my point. May 26th, these highs that came in here correspond to the highs in gold. We go to March. If you notice, they occurred at the same time. From there, we had a defined and strong multi-month correction. We're still in it. Now, here's the thing. On a technical basis, if it continues to fall, this is the first level of technical support. But market forces and market participants are focusing on the probability of a interest rate hike, guaranteed fixed returns on treasuries and whatnot, shift the attention to the riskier aspect of gold, which has a potential to move faster and higher than other assets, but also in a correction, it will do the same thing. That's what they're looking at. The focus is shift because the fundamentals have grown to a point where they're talking about rate hikes, and that is what gold is most sensitive to. Again, gold doesn't bear interest. So when you have attractive returns because they go up, you tend to see money move out of many asset classes, including some equities, and into the fixed income arena.
The breakdown of major psychological barriers has left technical charts vulnerable to extended corrections, prompting a recalculation of near-term price targets. Candlestick formations reveal that recent intraday recoveries were entirely unsustainable, as real bodies consistently closed lower and signaled a high probability that previous floors will dissolve. Market participants are increasingly pricing in a 50% to 70% probability of an upcoming interest rate hike rather than an anticipated rate cut. This hawkish shift is poison to non-performing assets, driving capital out of equities and precious metals directly into the fixed income arena, where yields are becoming vastly more attractive. Furthermore, historical data reveals that silver typically outperforms gold during strong bullish cycles, but suffers a much sharper percentage decline when bearish sentiment takes over. Both metals recently hit a defined apex before entering a multi-month correction that continues to dominate current trading patterns. Now, let's get back to the interview.
We're trading slightly below that, and it does appear it's going to be on a closing basis. We're going into the weekend. So we might have a new floor because this floor obviously is not holding. 4,000 is a strong psychological level, but the traders are going to bid it in where they think it's going and not necessarily what it is. Of course, the big if is the Fed, but there's almost a expectation that's kind of priced in. And inflation, because that could cause or will cause, I believe, the Federal Reserve to act. And if they act, they're going to raise rates. And that's poison to gold, is when a fixed asset, guaranteed asset, is producing more revenue, where gold tends to be more speculative, although for hedging it is different. Physical accumulation is different, but not for traders. Well, we're looking at a daily chart of gold futures right now. I believe it's on the August contract. And if you notice these two lines here, and this is, of course, about 4,060, and it's really based upon this price activity in November. If you go back to the end of October, you've got this another little floor, and that comes in at about 39.34. We obviously cracked this. We have broken below 4,000, and we've tested it. Let me blow this up a little bit. We've tested it a couple of times, but you see they're just wicks, meaning the open and close are represented on a candlestick by the body. Closing higher compared to the open is green, closing lower compared to the open is red. But what you really want to watch or look at or look for is these wicks that come in, and they're coming in roughly at about 39, 64, 63 in that area. And that, I believe, is going to be a critical area now that we have broken through gold, but more importantly, we've closed there. And as we go into the weekend, of course, the wild cards are Iran, the military activity, geopolitical potential to cause this market to get excited. But I have to really put a caveat on that because we've seen many asset classes, and gold specifically, not moving in A plus B equals C, meaning the talk of a rate hike, that has obviously moved gold. But then whether there's military action, things that used to be highly supportive of gold have not seemed to have the same effect, which I interpret as what market participants are focusing on, and that is interest rates, not geopolitical activity, and putting a priority on interest rates rather than geopolitical scenarios. And I don't think it's a pivot as much as we're talking about a rate hike, and we haven't talked about that in quite some time. I think it's a double-edged sword, and the other side of the sword is the intense focus on interest rates and what the Fed's going to do. We haven't had a rate hike in a while. There hasn't been talk of that in a while. Our new Fed chairman has definitely put that on the table and has supported I believe a high likelihood that there will be a rate hike, specifically more than we see a rate fall, where no one is really anticipating that. He has come out solidly saying any inflation level above 2% is not acceptable and will do and take whatever steps are necessary to put a ceiling on rising inflation. And the easiest way to do that, or the primary, possibly the only tool of the Fed, is rates and raising them when they want to hold a cap on where certain markets are going, and where if you peg it on inflation and inflation ticks up, and they've said that's what will cause them to react and implement a rate hike, it changes the scenario in terms of where market participants are focusing on. I don't think they've pivoted. They are reacting to the fundamental events that are occurring on a monetary policy basis by the Federal Reserve.
A double-edged sword now hangs over the financial sector as monetary policy actions take absolute precedence over global geopolitical instability. The Federal Reserve's unwavering stance that any inflation level above 2% is unacceptable has effectively placed potential rate increases back on the negotiating table. Because raising rates remains the primary mechanism to combat rising inflation, market participants are forced to react strictly to central bank policy, rather than traditional safe haven catalysts. Technical indicators show a clear breach below the $4,000 level, leaving the market searching for stable ground as it heads into a highly unpredictable weekend. If the current downward continuation gains momentum, the next major area of technical support will rest near the October lows of $3,934. Ultimately, traders are no longer bidding on current valuations, but are instead positioning themselves for where they anticipate policy will head next. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.